Amid the COVID-19 pandemic and the subsequent lockdown that sapped demand for retail giants with malls shut down, plus the travel restrictions that's choked the offshore gaming industry, what's next for the real estate sector? When can it catch the next break? Joining us now live, David Lichu of Lichu Property Consultants. Hi, David. Good afternoon. Thanks for joining us.
Hi, Mimi.
Hi.
Thank you.
So, David, let's start with the malls. How much pain should our property giants expect from having their malls shuttered? SM obviously has one of the biggest exposures at 40%, followed by a 20% chunk, and then 16% from the Gokongwei Group and 14% from the Ayala Group.
Yeah, I think, one day they went from 100% occupancy and revenue stream to very quickly 40% and now almost zero. And I think that's the reality that they're facing right now. And another chunk of their portfolio is also hit, which is the hotel sector. Again, very same numbers, but much earlier. And I think the numbers are more or less at around 0 to 10% occupancy for many of the hotels.
And so, David, what's the outlook now? I mean, what is your base case? How long should they prepare? How long of a lockdown should they be bracing for? Because we're very close to the end of the 1 month lockdown. Should they be ready for a second, third, fourth month of a lockdown? And even then, we don't even expect people to be racing to the malls, even as the ECQ is lifted.
That's right. I guess we're nearing the point where we have to decide: do we choose health? Do we choose economic progress? Right? No point getting hungry. So I think we're going to have another month or two of some kind of lockdown just to slow down the virus from spreading. But at the same time, we have to open some of the businesses to keep the engine of the economy going. Or else a lot of things will start to fall apart and crack, primarily the social structure and peace and order. And then we also have to remember that of the 15 million square meters of retail space, there's tens of thousands of businesses that are depending on the survival and the opening of the mall. And at the same time, hundreds of thousands of people are depending on their jobs for the malls to be open. So we have to strike a balance between addressing the virus and keeping jobs alive.
David, from retail, let's move on to the office market. Ayala Land, we have a slide here, your slide number 35. Ayala Land is leading the pack, followed by Philinvest and then the SM Group. Do you expect demand or supply to be going down?
Definitely this year we're going to get a hit. Last year we did fantastic at 1.7 million square meters total country take-up. This year we're projecting about 800 to 1 million square meters of office space taken up in this market. We've already gone through almost 20% of that number in the first quarter of this year. And we expect the second quarter to be almost zero in transactions, but all of that will catch up in the third quarter, beginning sometime in August. So August to December, we will make our journey from 200,000 square meters taken up to about 1 million square meters, and possibly more, because I think we're gonna have some level of adoption with this virus in the next month or two. And then after that, leasing activity will start to happen again. And what will drive that will be primarily the BPO sector, because as the world goes into a global recession because of this virus, more companies will cut costs aggressively, as they have done and learned the hard way in 2008 and 2009. And because they're wiser now, they will be more thoughtful about offshoring to Philippines and to India. And so just like what we saw in 2008 and 2009, we're going to see a big spike we expect a big spike in office transactions led by the BPO sector towards August and beyond. And the travel bans that we are experiencing right now, because China and Taiwan and Hong Kong and Singapore are now stabilizing, and South Korea, you're going to see possibly air traffic open again between countries. And that should spur the POGO sector from opening again. And we would expect them to have a big comeback towards the year end at the same time as the BPO.
So, David, very quickly, because last year was a POGO kind of year, they overtook the IT-BPO as the biggest driver for demand. This year, IT-BPO is back as the biggest source of demand, correct? Is this a trend that you're seeing for the rest of the year?
Yes, definitely.
So let's now, you mentioned transactions. You're expecting almost 0% transactions for the second quarter, things to pick up by the third and fourth. You do have a slide there about this year in transactions, slide 17. We're showing it now. You've got the blue line representing 2019 and the orange line in 2020 with your projection. Could you explain this chart we're showing now?
Yeah, so you're looking at what's that? History from 2006, right? Is that the one you're looking at?
No, it's the one with a year in transactions, 2019 versus 2020. And
yes.
well,
Okay.
2020 is okay.
Yeah. So 2019, we saw a lot of transactions fairly evenly spread throughout the year. We are seeing demand fall from 157,000 square meters first quarter to almost zero in the second quarter. But all that will be caught up towards August to December of this year. So we're just trying to monitor the movement of leasing activity. We are being conservative about zero in the next 3 months. The reality is that we still see 630,000 square meters of office transactions that want to happen. It's happening at a much slower pace, but these deals will most likely happen within this year. And that's why we are optimistic about our projections.
And for the pipeline of office supply, you're expecting to see a curve, a flattening of the curve, the supply curve, which is going to help offset slowing demand for office space. Could you expound on this as well?
Yes. So the funny thing about this crisis is that the demand is slowing down, right? Dramatically. But it's not just the demand that it's slowing down, it's also the supply. Unlike in other crises where you're seeing a drop in demand, but the construction activity still keeps going, here, both have been stopped. And so I think when the engine starts to rev again and you start to see construction, you're going to see a lot of projects being delayed. In our estimates, it could be as low as 40%, as high as 50% of projects delayed to next year. And therefore, the actual supply that's entering the market this year will approximate the demand. And so we will still see equilibrium. And therefore, we will avoid what many people fear would be a glut in office space. And while you see while it builds up in 2021, we expect that by 2021 the demand will normalize, and instead of being suppressed by the virus dropping to 800,000 square meters, a million, to probably normalize closer to what we did in 2017 and 2018 and 2019, which is about 1.5 to 1.7 million square meters.
Okay.
And so you're going to see equilibrium all throughout until 2022.
Okay, David, moving on now to REITs, Real Estate Investment Trust. We were so bullish about REITs, then the blackest of swans came along. Are you still as optimistic with REITs?
Yeah, because we were delayed in this REIT process for 10, 11 years. What's another year of waiting, right? I don't think the companies list that we're hoping to list this year will do so. There's probably a chance that they'll do so at the end of the year when the sentiment in the stock market is better. However, the point we're trying to make here is that only 1% of global assets are REITed. And I'm so happy that in the next 12 months, there's a very good chance that Philippines will contribute to that 1%. But second is that there's a very big opportunity in the REIT because of the amount of assets that we have here. 30 million square meters of assets, of which easily 22 million square meters are REITable. very few countries can go to the market and say, we have 22 million square meters of assets to REIT. That is going to give the REIT market a very long run, just like what we saw in Singapore. I mean, Singapore, as small as a country it is physically, they have close to 50 REITs in Singapore. And they are the idol of the REIT sector. And we want to be like that. And I think we have a very good chance because of the quality of assets we have in the office, in the residential sector, in the hotel and mall sector, infrastructure, hospitals, jails. The opportunities to REIT products will be pretty significant.
Now, final question, David. From a consumer perspective, will this pandemic cause property prices to go down? Is it time to buy for those who have the cash? And okay, let's go with those two questions first.
I can assure you that there's a lot of dry powder out there. Many of my clients have called me the last 2 weeks saying, if there's any buying opportunity, we want it. The problem here is that nobody wants to buy pre-COVID prices. And everyone will, and so far, the ones who have called us and said, we want to sell our assets, will only do so if they can sell it at pre-COVID prices. The reality is that the property market is a much slower market to react, unlike the stock market. And so chances are we might be out of this COVID situation way before you see prices drop. Now, the only exception to that, caveat to that, is that if this process takes longer than 4 months. If this adaptation to this COVID lasts longer than 4 months, then I think you're going to see some distressed assets beginning in the secondary market of the condominium sector in the middle end segment. It will take time before the high-end market gets affected. It will take time before you see office buildings being sold at a discount. Because at the end of the day, the office sector is still providing significant cash flows to many property owners.
And final question, David, with many Filipinos or small businesses expected to feel some tightening of their cash flows, this means that they might have harder time to meet their debt obligations for properties they may have bought before. Do you think there's a real estate bubble to burst at this point?
I don't think so. It will take a very, very, very large number of casualties before something like that will happen. Comparing this to the Spanish flu, the COVID looks very modest in terms of casualties, etc., compared to the Spanish flu that hit us 100 years ago. And there are many reasons why the mortality rates are so much higher then. But I'm just using that as a reference because it will take much more damage before you start seeing that in the banks and the property sector.
Okay.
I think the goodwill between people is very strong in the sense that the banks are saying we're willing to defer payments. The real estate companies in malls and hotels are saying we're prepared to defer payments. You see it also in the residential sector where landlords themselves are going to tenants and say, if you need more time to pay, you have it. And so that's going to just cascade. Everyone's in it together. And I always like this quote of Jack Ma, today is bad, tomorrow will be worse, but the day after tomorrow will be sunshine. It will be beautiful. And that's what we all have to look forward to.
Okay, David, we're looking forward to seeing you the day after tomorrow. Thank you so much for joining us this afternoon, David.
You're welcome. Thank you for having me.